Welcome to Get Your Coins Sis podcast, the audio show designed exclusively for you. I'm Nell Latrice, your host and fellow mom on a mission to empower, inspire, and guide you on the path to financial independence. Tune in for expert advice, real-life stories, and actionable tips to help you secure the bag and truly get your coins, sis. Because you deserve financial success and stability. Let's thrive together. Hey, welcome back to the Get Your Coins Sis podcast. It is your host, Nell Latrice, and today we have Brian Riddick. He will be talking about how you can get a mortgage loan and the different types of mortgage loans. I will have Brian introduce himself and tell us a little bit about him.
Hi, as you introduced, thank you for introducing me. My name is Brian Riddick. I'm out of Virginia. I've been in the business now since 2015, in various roles as far as underwriting, processing, sales manager, pipeline manager, everything that you could do in this industry, to understand it better and to facilitate helping people get through the process faster. My background extensively as far as education is I am a double major from Old Dominion in econ and finance. Um, I've been running a team now probably since 2019. I've been running my own team, and that sums me up in about 10 years of working experience in the mortgage industry.
That is great. So, how did you get into mortgage lending? So, you have your degrees, you have all of those accomplishments. What made you get into lending?
Um, the biggest thing I always wanted to, what I want to do is get to the Federal Reserve. I wanted to be as one of the boards of governors, some capacity working for the Federal Reserve. There is one localized here in Richmond, but that's primarily how I got into the mortgage business, was learning about the Federal Reserve and watching a movie called Too Big to Fail. That just drew my interest into wanting to find more about mortgage banking and mortgage lending overall.
Okay, I need to check that movie out myself. I've never heard of that. Okay, that's on my list now. It's called Too Big to Fail.
Too Big to Fail is an HBO film.
Okay, cool. I'm gonna make sure I check that out. So, what do you enjoy most about your job?
My main thing I love is numbers and people. I was going to find a job somewhere to work with numbers and people in some magnitude. So that's basically what got me into wanting to, get into the industry, and that's what also keeps me in the industry is I get to work with numbers and I get to work with people, all every day basically.
Yes, it's so good when you can combine your work with your passion. I think that also helps you to be more successful in the things that you do when you really love it.
hmm
So that is so good. So what's a common misconception that people have about getting a mortgage?
Uh, it's many, but primarily the one I think a lot of people have a misconception about is your credit score determines how high you can get approved, and it's more of a combination of your credit and your income. But I would say primarily your income is going to determine your buying power, and your credit score is going to determine the programs you can go into. So just those combinations of which one matters the most, I feel a lot of people have that misconception of what matters more in the transaction.
Okay, good, good. And we'll get into that a little bit later on, so people can understand what type of score you may be looking for. But what is the difference? I think one of the things that people have a hard time with is the difference between a mortgage lender, a broker, and a loan officer. So, can you tell us a little bit about what is the difference between those different people and how they work with mortgage lending?
So a mortgage loan officer is going to work for either a mortgage lender or a mortgage broker. It's just the role is called mortgage loan officer. You might see loan originator, sales manager, but ultimately they're all the same role, just a different title for different companies. The primary difference between a mortgage lender and a mortgage broker is a mortgage lender is someone who does retail. So think of it in the sense of like a Bank of America, Navy Fed, national name banks. Those are mortgage companies. So we're all going to, do mortgages primarily. Mortgage brokers are the same. The only thing is most of them don't have brick and mortars for you to walk into, and their cost is substantially less. So they say, hey, we give you lower rates than a mortgage retail company will. So those are the two primary differences. They're going to both do the same as far as offer you a loan product, the same products, primarily the same type of requirements and what you need. However, the only difference will be the cost of it and how fast they can do your loans. So that's pretty much the makeup of mortgage broker, mortgage lender. when it comes to that standpoint.
Okay, yeah, because when I just bought this house that I'm in now, my mortgage guy, he was of course had his own independent company,
Hmm.
and but he originated loans from Huntington Bank. So that's where I ended up getting my loan through. And he was kind of like he got a kickback. Of course, everybody's here to do a job and make money. So he ended up, getting my loan through Huntington, and and I didn't know that's how that worked at first. I'm like, oh, that's how that works. Basically, he shops around for them,
There you
and
go.
in turn makes money for his company, which
Correct.
that's what it's there for. So I did not know that.
So it's like when you go into a car dealership. If the car dealership is going to offer you, the car, but they're going to say, "Hey, we can help you with financing," but ultimately going to shop you across multiple lenders. The same applies when it comes to mortgages, where if you go into a bank, that bank is what's going to finance you. But if you go to a mortgage broker, they're going to just shop to see who's going to give you the best score. I'm just giving you the best rate for what program you're looking to use, and to see who can do it the fastest in regards to their broker setup.
Okay, that is so great. So, what is some basic steps that someone should expect when they're going through the mortgage process?
You should honestly be prepared for your financial life to be dissected in every way, where it's not a question of you. It's a question of, hey, we have to follow the law, and we, the mortgage company, do not want to get in trouble because our loans and our process, we're audited by the federal government at random. So they want to go through the process as if everyone's getting the same product. So be prepared for your life financially to be dissected from every transfer in, every transfer out, any indications on your pay stub as far as you might auto pay something from directly from your pay stub. It's not questioning are you doing anything illegal. It's hey, we just have to document it so we can say we have that actually documented so that when we get audited, it can be addressed and answered cleanly for them.
Yeah, yeah, because that happened to me. So my job had overpaid me. So of course they wanted their money back after they overpaid me. So they was taking it out of my check
Hmm.
every 2 weeks. I work for the federal government, and they was taking it out of my check every 2 weeks. So then when I was getting the loan, they was like, what's this? I'm like, well, they overpaid me. This is me
Hmm.
paying them back. So once I sent them my check stub, they seen it because they know everything on our pay stub. So it said that it was for overpayment. So then, but they literally scrutinize every last line item. If anything is out of place, you will get questioned on it. And I learned that when I was getting a loan. I'm like, oh,
Yes.
I didn't even know that mattered. Like that they overpay me.
I tell everyone don't take it personal as if they're trying to attack you. Is we have to the laws changed. The last time the mortgage laws changed dramatically was 2008, and it allows us to even to a point where even if you're transferring $10 to someone else through Cash App, technically we got to find the money. We got to follow the money. Doing so, we now got to see your Cash App statements. While we're looking at your Cash App statements, we see even more transfers. So I would say just be prepared that if you're going to buy a house, stop any large transfers. But if you can't, just be prepared to address what those transfers or deposits are coming from, and they will help you walk through the steps of how to document it. But just don't take it personal.
Yes, that's a big thing. That's good. So if someone is coming to you to apply for a mortgage and hey, I'm putting in my application, what are those first things that you do? So what would someone need to send you in order to get a loan?
So they were saying pay stubs, W-2s, ID, and the point of contact for how you pay your rent. So if you're renting right now, they're gonna want to know the contact information for your landlord. Not that they will reach out beforehand, but it's just like, hey, if we do need to reach out, we know who to go to. Me personally, I will tell you if we're going to even reach out. I will tell you beforehand because sometimes landlords get a little weird when you are trying to move. So we try to prepare ourselves best to do that the very last thing, but always have ready for all of your documentation of bank statements, pay stubs, W-2s, and IDs to be prepared to hand that over so that we can scan them and put it in the system to see what we can at least offer you as far as the program. Once we have the program, there's another round of what more things we need to get from you because these programs are going to be detailed to documentation too.
Yep, yep. Because I know when I was doing mine too, I have another mortgage, so I have tenants that was going to be living there, but it was like a third party company that called me, and it was so weird how they do stuff. Like I don't know, they didn't really announce themselves. I'm like, who is
Hmm.
this? They like we just calling to verify that you've been paying, your mortgage, and I'm like, this sounds kind of generic. So I had to call my lender. I'm like, I want to make sure these people are legit because they're asking, for information.
Yeah.
So when I talked to him, he was like, "Yeah, those legit," but they really were very informal in the way that they asked me for information. So I do want people to know that, like he said, people will be calling around trying to figure out where your mortgage is due or your rent or whatever to make
Mm-hmm.
sure that you have been paying it on time.
I'll add to that is your loan officer is going to should or will address you to let you know, like, hey, we're going to verify X, Y, and Z. Being that we're loan officers, we're technically considered interested parties because we're going to get a commission for doing the loan. So we can't be the one to verify. It has to come from an independent third party. And generally speaking, I will let you know, like, hey, this is going to be a person from this company. They will tell you they're from this company and will be asking for information such as date of birth and social, so they can do a 3-way conference call with you,
Yep.
with whoever they need to verify. Because that
Yep.
is scary, because this process, once you get your credit pulled once, you will not get nonstop calls throughout the
Over
whole
and
process.
over.
Everybody,
Yep.
including other companies, trying to see if they can flip you.
Yep, that's I was getting all kind of crazy calls. That's why I'm like, this is kind of. I'm like, I'm kind of skeptical about who this is. Let me double check. I was like, y'all gonna have to call me back because I need to see. It was really
Yeah.
weird. So yes, I always verify and follow up with who's calling you for stuff. I want people to understand that. And one thing I wanted to address with the whole W-2 or statement or pay stub piece, I had seen something going around social media about like Afterpay and Klarna and those paying for type companies. How does that affect your credit report or you getting a loan? Because I really wanted to clear this up for the listeners, for people who had questions about that.
So I actually made a video about this just literally last week in
Okay.
regards to this situation. This is new. So these 4 services, as far as Klarna, Afterpay, Affirm, I can't think of all of them right now, but they allow you to chop up big sums of payments into 4 payments over the course of 4 to 6 weeks. It works in the same as if they were on your credit report without them being on your credit report. So we will have to document the payments that you make out and add it into your debt to income ratio. Now you will look at it as, hey, I see I only have to pay $20 every 4, every 2 to 3 weeks. But when we add that up in a month, it's more than $20 a month. So that has to be added to your debt to income unless we could document it, it's been paid off. Or if you want to, you go ahead and just pay it off right there on the spot so we don't have to count it. But it won't stop you, but we do have to add that into your debt to income when you do pay these services.
Okay, y'all. So y'all heard it. So it does affect your DTI. And one other thing is, what for people who don't know what a DTI is, can you explain what that is and how that affects the mortgage lending process?
So it's your debt to income ratio. That is going to determine your buying power under the program you're using. The formula for debt to income is taking your income and taking the monthly payments you make on your credit report, such as student loans, car payments, car insurance, not car insurance, but car loans, student loans, regular loans, any financial payments you make, add that into one column as far as what you pay out per month, and then divide it by your gross income before taxes. That gives you a percentage, and that percentage is basically going to tell us what you can buy on a house. But that part is where, if you are making Affirm payments, we will have to add it into that particular situation.
Okay, perfect. That is good. That is good. So, how does the pre-approval process work, and why is it important?
So, to the definition of pre-qualification and pre-approval. So, pre-qualification just means you talk to me, I pulled your credit. I didn't even get any documentation, but we ran you into a system called Desktop Underwriter, or DU as they might abbreviate it. And if that system says yes, based off what you put on the application, we will give you a pre-qualification letter. You can start shopping. A
Mhm.
pre-approval means you gave documentation to back up what you put on the application. You also now have been reviewed by me and an underwriter, and the company is going to give you a commitment letter saying, as long as nothing changes as far as your income, nothing changes on your credit, you can buy a house, and we're almost virtually guaranteeing you can close on a house, whatever price range is on that pre-approval letter.
Okay, perfect. Because I want people to know to shop around for lenders too. I learned that when I had was getting my second place, and I had got up pre she ran my stuff, she pulled my credit report, I sent her all of my documentation, and she had never got back to me after she said I was approved. So I was kind of like, yeah, I was like, that's kind of weird, so I want people to also know that when you shop around for a realtor, shop around for a lender too, for someone who's going to match you and who is going to be attentive to whatever your needs are.
I always say, if you're not getting the customer service, lead to the real estate agent, because primarily the relationships we have are with the real estate agent, and that's why you're working with that loan officer.
Hmm.
That real estate agent should have vetted that loan officer and made sure their customer service is up to par. But if you feel like you're not getting it, even if they're picking up the phone to answer your questions, but just feel like they're being short or it just
Mhm.
doesn't feel the right energy off, let your real estate agent know. Maybe there could be a conversation because maybe that loan officer at that time you're calling them was dealing with multiple things or whatever the case may be. I won't make no excuse for it, but just have that conversation first to see if it's something to be cleaned up. Because what you don't want is your credit to be pulled by multiple lenders unless it has to be pulled by multiple lenders for the purpose that I just don't feel like this person's going to be able to take care of me. I want to go somewhere else. At that point, you need to go somewhere else
Yep.
because this is never going to change in what you feel in your heart. So what I would say is talk with the real estate agent first to then have another conversation with your loan officer to see if there was something maybe there that, hey, I was dealing with X. So that's why my energy wasn't there.
Yeah. That's so good. I ended up the first time I didn't shop around. I went with the first people I found. But the second time I did. I think I shopped 4 lenders.
Mm-hmm.
And I want people to know too that all of those fees vary from lender to lender. I know that one of the lenders I was going to use, they wanted like with my down payment and everything, the estimation based off of what I was going to borrow was going to be like $25,000. So when I shopped around to a different lender, then it went significantly lower to all my stuff was only going to be like $8,000. So I want people to look at those big names too of those lending companies. Sometimes those fees can be way higher than they should be, and you may be able to get some lower fees with another lender. So I do like the when I can go to a smaller person who has their own company, and they're able to give you the more, good kind of, service that I'm looking for.
What you're referring to? What I'll say is
Yeah.
when you talk to a loan officer, they even give you the pre-qualification letter. Ask them also for an estimated closing worksheet as she received. With it, what I'll say is when it comes to comparing lenders, look at only Section A.
Okay.
Section A is really all lender-based costs. All
Hmm.
the other sections are third-party companies that they don't have any control over. But Section A is 100% the control of what that mortgage company is
Hmm.
offering as far as costs. You'll see words like discount points. You'll see origination points, processing fees, and underwriting fees. Those will vary every company. There's not going to be one company that's going to have the same exact number.
Hmm.
And even if they do, it's something there that you might not have seen. Like, hey, it might be something that I'm not being disclosed just yet. Because I know some loan officers play the game of not disclosing their fees until you're under contract.
Yeah.
Because technically, legally, they're not disclosing their fees legally. They're saying at this time, this is all we have to disclose. So you're not seeing it all until you get under contract. Where legally, they have to disclose everything to you.
Yes, that happened to me. I'm so glad you cleared that up because I seen that. I didn't know what it was, but I was like, no, I might as well go with a different lender if I'm going to pay, significantly more with this
Mm-hmm.
one for the same amount that I was approved for. So
Mm-hmm.
I was just like, no, that's crazy. So what is the difference between a FHA, VA, a fixed rate, adjustable rate? Can you talk a little bit about that just in case people don't know what those different loan types are?
Yeah. So conventional, excuse me, let's start with first. FH, fixed rate on adjustable rate. A fixed rate mortgage just means your mortgage rate will stay the same for the duration of the term of your mortgage. So if you sign up for a 10-year, 15-year, 20-year, 30-year, 25-year mortgage, the mortgage rate is going to stay the same for 30, well, how many years you signed up for. An adjustable rate mortgage is going to have based on which terms you sign up for. So if you watch the movie Too Big to Fail, you'll see a lot of in that movie where that's basically what primarily collapsed the mortgage economy was that a lot of people had adjustable rate mortgages and they didn't know. It basically is going to change. Your rate on your mortgage is going to change based on the index mortgage rate of the national rate. So, and it's caps. It's kind of hard to go into detail, but it's caps of either 2, 3, or 5, where that's how high your rate can, jump.
Wow.
So, for example, if your rate is 3 and the cap is 5, but the rate for the national rate is 6, then your rate is going to go up to 5 and be capped there for that time frame of the increase. But technically, your mortgage rate just went up, so your payment's going to go up with it. So that's the difference between fixed rate and an adjustable rate. Where basically, if it's fixed, that means it's fixed for whatever term frame you signed up for. Adjustable, it means it's going to adjust on every time period you sign up for. So if you adjust it for every 3 years, 5 years, or 10 years, that's what's going to happen on the adjustable rate mortgage, where it's going to just change based on your terms.
Okay, I have a question about that. So what would be a scenario where someone would use an adjustable rate mortgage then? Because of course it sounds more appealing for it to be a fixed rate.
For me, I would say adjustable rate mortgages are better in those economies, the markets in which the real estate jumps significantly because it's in a benefit to you that, hey, my rate is going to jump but also the equity in my home can jump to the point where I want to lock in on this lower rate on the value of the house today. And if it does go in significant jump in equity, I can just refinance to a fixed rate and I'll have the equity that I'll need from that standpoint to get me there. But if you're in a market where real estate does not really exceed the national of 3% every year, then it's in the best interest to do a fixed rate. Some people also use it for, I'm a short-term buyer where I'm only going to buy this house and live in it for maybe 2 or 3 years, but I want to put down a substantial amount of money. I want the lowest payment, also the lowest rate with that too. So, hey, I want to sell this house probably in 3 years. Adjustable rate mortgages are generally what most people want to go that route too.
Okay, perfect. That's so good. That's so good. So, between what would be a good start, FHA, VA, or a conventional loan, USDA, what are a little bit about those different loan types so someone can know if a loan is for them or not?
Okay. So the difference between the two, FHA, USDA, and VA are all government-backed loans. What that means is the only one that doesn't have the only one that does have mortgage insurance is the FHA loan. So every month you're making your mortgage payment, mortgage insurance is in it for FHA. And basically, if something goes wrong, such as a foreclosure, you file bankruptcy in the house and you're going to exit the house, that mortgage insurance is made to help cover the cost of basically the bank taking over the house. That's what government-backed loans are doing. They're helping that cost be discounted to you as a person versus, hey, you have to pay what the market rate is for mortgage insurance. With conventional, it's not government-backed in any way. All of it is singly, plural, however you want to put it. It's all based on you. Your credit score is going to determine the rate, the mortgage insurance, and everything about that whole setup. When it comes to program requirements, anything government-backed is going to be more lenient. So if you have situations where you had credit history in the past that was kind of shaky, any government loan will be in the best interest for you versus a conventional. Most people don't want to say it, but if you don't generally have a 700 credit score, you probably want to stay away from a conventional because the cost is going to be kind of crazy on those for you if you're under 700. Now, the only one that is specific to a certain subgroup of Americans is the VA loan. You have to be military based, be it active duty, be it retired military, or be it a surviving spouse of a deceased military member. That's the only way you can get a VA loan. But when it comes to those three programs, the minimum score for government loans is 580.
Okay.
FHA will let you go down to 550 if you find the right bank who would do it with you, but they will ask for you to put down a large amount of money to do the 550 credit score FHA. So it's going to really, the lower the score, the government-backed loan is going to be better for you. Whereas the higher the score, the conventional loan is going to be better for you.
Okay, yeah, because I did get a conventional loan the first time, but it was under the first time home buyer too, so I only put 3% down. I
Mm-hmm.
still pay PMI, but I only pay PMI until I got to 70 loan to value, I believe it was. And
80.
then it fell off for me after I did. And I got there pretty fast because I did a 15-year loan instead of a 30. So it got me that little $40 a month came off
Mm-hmm.
quick. So I want people to know I have an FHA loan too now on my current home. That the PMI is not going to fall off unless I
You completely sell the house or you
yep,
refinance
or
out of the program.
refinance. Yes, yes. So that is important to note. And what is your outlook on doing a 15-year or a 30-year mortgage?
To me personally, when it comes to 15 or 20 or 30 or 20, it just depends on your financial situation. If you're at a point where you peaked financially as far as, hey, this is the most money I'm probably gonna make per month or per year, then you probably want to stay away from the short-term mortgage loans because at that point you're at the top end of your income history, and at some point now you're taking a lot of that money now to pay for the mortgage. What I will say is if you can afford to do a 10-year or a 15-year, you can afford to do the 30-year and just pay extra as you choose to
Mm,
technically control your cash flow in and out each month. Because again, if you commit to that 15-year mortgage, you're committing to almost double the payment
yeah.
versus a 30-year mortgage. So it's
Hmm.
just one of those things where it depends on your financial situation of if you're at the beginning of your financial journey, then 15-year, 20-year mortgages are not bad for you because you're going to start to see gradual increases in your income.
Yes.
It doesn't feel as tough to make those mortgage payments each month.
Yeah, that's true. I did like that the first time I got a loan. Cause I didn't know anything. I didn't even know what I was doing. But what I was paying in rent, she like, well, the place you're buying, what you're paying in rent, it would cut your mortgage down to half. I think my rent at the time was like $1,100.
Mm-hmm.
And she was like, your mortgage, if you did a 30, would be about $500 or $600. But she like, if you do the 15-year, you still will be paying under the $1,100, which you are already paying. So she was like, I will go ahead and do the 15-year because then you will pay it off quicker, and
Mm-hmm.
more money has been going to my principal. So I'm glad she pushed me into doing it. Now that I look back at it, because now I have a bunch of equity in my place, and now somebody else is paying the mortgage on it, and I'm still making extra money. So then in that scenario, that did work out for me. So that is true, but now I have a 30-year because it's gonna be way more. So I was like, go ahead and give me that 30-year this time because I can't afford no double on what this costs.
And that's the thing. Even if you can't afford it, you can go to the 30. You can put those extra payments to the mortgage each month. But
Yes.
let's just say, you know what? I actually want to take the money I was going to apply to a 15-year, and you can do things around the house with that money to now
Yep.
increase the equity faster. Where maybe I take the extra 1,000 a month and just do a home based project, or
Hmm.
put money to the savings account so that I can, have money set aside for a contractor to come in and do the kitchen upgrades I wanted.
Yep.
That would increase the value of your house too to help you in the future. So it just depends on your situation, which one would be better. But is it worked out for you? It works out.
Yes.
Not to say it won't work out for everybody. It just depends on your situation of if it will benefit you immediately to do a 15-year or 10-year or whatever case may be.
Yes, that's so true. I'm a numbers girl, so I always make sure I crunch the numbers. So I'm like, and it made sense. So that's so true. So yes, do whatever is best for y'all. I always tell my listeners, my experience on what I've done. I never take my word for, set in stone, but I always tell them my experience since I kind of willy nilly do stuff.
You have
Without-
the conversation with your loan officer too. So
yeah.
yeah, you have to have that conversation with your loan officer. Um, don't just have it with family and friends. Have it with the loan officer too, because they're going to see it in a way to help you have a full picture.
Yeah.
Ask people who bought homes. Ask your family. Ask friends, and ask your loan officer about what's the best route based off your financial situation, and you make the decision of who's giving the advice that benefits you.
Yes, amen to that. Love that advice. So, what are some do you have any first time home buyer programs or anything with lower income?
So I always tell everyone, it depends on your state. Each state's going to have their own down payment assistance programs. I'm in Virginia. There's a Virginia Housing Development Program that will take care of the down payment in the form of a second loan on the house.
Mhm.
But I also tell everybody, check with the city too. A lot of people do not check with the city to see if there's any grants available to help you with down payment assistance. They will ask for a little bit of a commitment of, you got to stay in the house for 5 or maybe 10 years, but they're giving you free money to then put as a down payment, take care of your closing costs, and immediately give you a lot of equity. And all you have to do is commit for 5 to 10 years to that house. I mean, most people don't understand that will set you up financially for the next 20, 30 years of your life, creating that much equity off the rip when you're buying the house. So check with your state to see which down payment assistance programs are available in the state. And also check with your city that you want to buy in, not the one you live in, but the one you want to buy in, if there's any grants available. Outside of that, on a national level, there's programs called Chenoa funds that also are down payment assistance. There's first-time home buyer programs through conventional called Fannie Mae 97.
Oh,
Freddie Mac has one called Home Possible, and another one called Home Style 97. Excuse me, Home Ready 97. So these are 3% down options for conventional for first-time home buyers only. And it's not a situation where if you do have a cosigner and they're not a first-time home buyer, but you still would apply for that program with the 3% down option.
ooh. Okay, that's really good to know. I didn't know about any of those programs. That's so good. That's so good to know. So I'm taking notes too. Let me write down just in case I need to
And
put them in my back pocket.
house hacking is now becoming a little bit more of a known thing. With FHA, VA, and conventional, you can buy multiple unit properties with the programs that you're using. Conventional was the only one that would change your down payment. Based on how many units you're going to get, depends on now that the down payment is going to flip to either 10, 15, or 25%. They have
Mm.
changed that. So now FHA and conventional will let you buy a multi-unit property and not change the down payment requirements. So if you found that a quadplex, triplex, or duplex, you can live in one of those units and rent them out to others. And that does apply to first-time home buyers too. So you can get into a situation where you find a quadplex where the mortgage is being covered by the person paying the rent.
See, y'all hear that? That's how you build a legacy right there. You get in one and you rent out the other and have somebody else paying your bills for you. That is a good hack for sure. So what are some financial steps that someone would take before so you want to do all of these things, what do you need to have in order as far as finances?
The first depends on who you are. If you are a W-2 employee, first things first is get all the documentations aware. I don't care if you're not buying a house for another 2 months or 6 months. Start collecting bank statements or know where to find these bank statements as soon as possible. Your pay stubs. The point of contact for HR is primarily the most important because a lot of people will say, well, I know the HR person. You'll give a number and they'll say, hey, I don't handle that. And you need to find a different number. So it just becomes a rat race of finding who is the point of contact to verify your employment history. If you are self-employed, it's a best time now to get your tax returns for the last 2 years. Who is your tax preparer or CPA, and prepare a profit and loss statement to go along with it. Outside of that, you should know your credit score. And I mean that even if you're not buying a house. And whatever you do, please delete Credit Karma, Credit Sesame, Credit Wise, any service that is saying they're giving you free credit scores, delete it ASAP. What they're doing is they're selling your information for free. There's no way in this country anyone gives you anything 100% for free. They're giving it to you so they can then sell your information. This is why you get letters in the mail. This is why you get emails, phone calls randomly just saying you've been pre-selected or pre-approved. This is why they sell that information so that when you do go to a mortgage company and we do pull your credit, you're going to get 6 to 10 calls from random mortgage companies saying, hey, we've seen your credit was pulled. We want to see if we can help you get your credit pulled with us too. So delete those services as soon as possible and just get rid of them and use something called myfico.com.
Okay.
That will 100% tell you your credit score at all times, free of, not free of charge, but they will tell you your credit score is 100% accuracy for everything you can shop for. And they will not sell your information because they're making the money off the membership fees that you're paying per month.
Ooh, that was good. So noted. So I hope y'all got your pen and paper ready because he's giving a lot of good gems.
I'll say it again, myfico.com is the best place to use it. It is like 35 or 39 bucks a month, but it gives you everything because you have a credit score for mortgages, car loans, credit cards, personal loans. They're going to vary for each one of those services. And most of these companies are going to sell you information to tell you something briefly that may be accurate, or they're going to give you just one of those scores, but not tell you which one of those scores it is.
Yes, yes. And please, if you're not willing to pay $39 for a credit reporting program, you are not ready to buy a home because it costs money to get your credit report. It costs money to get things in order. So I want everybody to remove the free notion from your head. Like remove it and please replace it with these good gems that Brian has given us so you guys can get y'all a new home, okay? So how does the credit score impact the mortgage rates? So, okay, we did all the steps that you gave us before. How does those scores impact what rate you're going to get?
If you're using a state entity program for down payment assistance, your score only lets you into the program. The rates are already predetermined by the state that's offering the down payment assistance. So even if you have whatever their minimum is, you can have their minimum or you have the highest score of 810. They're going to say those same two people will get the same exact interest rate unless they buy it themselves. But if you're using any type of FHA, conventional VA, or USDA, those rates will be determined by your credit score. There are buckets. The buckets are going to be like 580 to 619, 620 to 660, 660 to 690, and then 690 up to like 720. Each individual bucket is going to get you a different credit score in the mortgage industry. And just a slight increase of that one bucket from one point and up can save you almost a quarter of an interest rate, which depends on the loan amount, can be a substantial amount of money. Even if it's a little bit of money, it's still the fact that if you get your score at one point, you can save yourself on the interest rate and on your mortgage payment. But those two things, as far as the program you're using and your credit score, will determine 100% what your interest rate is unless you're using a down payment assistance program.
Yes, that's so true. That's what happened to me. My credit score for it was like 735 and up you get the lowest rate. I just made it, had a 736 when I applied. So either way, I ended up getting the best rate because like you said, those buckets, I fell into that last bucket on where you can get the best rate that they were offering at the time. And also my loan person, and also like you said, individually you can check with your lender. They may have other programs locally, because the area that I bought in, whatever program they use, he said that they bought my rate down for me 1% over the life of my loan. We didn't even know that was available until he started working with my loan and doing his part. And I was like, oh yeah, I'll take that one. It was like 6 something percent, so it ended up going down to the 5, less than 5.5%, because whoever this program was bought my rate down 1%, and that did make a difference in my payment, by like $100 a month.
State of Virginia has that too. Right now it's called Spark Funds. I don't remember what the initials stand for, but the Spark Funds will basically, if you're qualifying for the state program and the rate is 7, they're saying they'll give it to you for 6 free of charge. You just have to talk to them directly.
Yep. Those programs are so good. So, what percentage of income should someone ideally spend on their mortgage payment a month?
I'm going to give you the I'm going to give you the government answer, which is
Yes.
36%.
Okay.
You should not have a mortgage above 30% of your gross income,
Okay.
and with your bills included. The reason being is you don't want to be house poor. No one wants to buy the home and then sit on the home, and all you can do is just pay the bills. You can't even go and do in life enjoyment, life improvement, meaning you can't pay for other things. You can't have hobbies because all you can do is afford to pay your bills. So honestly, 36% is where you want to make sure that your bills do not exceed, including the mortgage you're going to be getting into, because you do not want to be house poor.
Yes, that's true. And I know the federal government uses gross income, but I only use my net income for my own
Exactly.
personal. I use my net income. Okay, this is what I'm bringing home. This is what I can afford. I don't use gross anything because they about take half of your money anyway. So I'm like, I need to use what I'm actually bringing home, because I can't do anything with gross, with deductions, what they taking out of my check. I can't do anything with that.
Even with the gross, like we only see what you pay on your credit report. You still have food, you have
Yep,
gas, car insurance, you have other bills that are not going to report on your credit report that we can't account for. But that's personally for you to account for. Of, hey, I
exactly.
still have to pay those other bills, and I want to make sure I can pay them and still go out and have fun.
Yep, exactly. So please, y'all, do not use one of your whole checks on just a mortgage or your rent. Please don't do it. So how much of a down payment is usually required? So I know you said FHA is the 3%. Um, and I think you said that conventional is maybe 5, 10, 20, just depending on, so typically what does it look like for a down payment?
So FHA is going to be 3.5%, no matter what. As far as you're buying 1 to 4 units, 3.5%. Conventional, if you're a first-time home buyer, they will let you do 3% down. If you're not a first-time home buyer, it's 5%. If you're using USDA or a VA loan, then it's 100% financing, and you don't have to worry about a down payment at the time of closing.
Okay, perfect. So we talked about some things about PMI. We know what private mortgage insurance is. What else costs do people have to look for when they are closing on their mortgage?
Number one cost, look at what I'll say is processing fees and underwriting fees. Yes, they will vary at each company, but they're not going to take the fee off the sheet for you. It's one of those what's the word they use? They're gonna say discrimination. So we can't charge you a fee and then not charge the next person for the same fee, because then it looks like a discrimination thing. And on
Oh,
paper, they only can look at what's on paper. They don't know the story or the situation of why we took this off for you. So everyone gets charged that fee as far as processing underwriting, even though it is going to vary each company. What you can ask for is, hey, I don't like, you can have the conversation with your loan officer to see if they're able to, but there's something called a lender credit. And that lender credit can offset that cost of the processing fee or the underwriting fee. Those two things are going to be 1 and 2 as far as what will be something that the lender can control. Anything that says appraisal, um, title insurance, those things are the third party fees. And they're going to have that conversation with the company that technically is charging the fee. Yes, the mortgage company is disclosing it on their forms as far as you have to pay all these fees, but the only one the lender controls is primarily in Section A. All the other sections are going to be either the title company or it's a third party vendor that they reported cost for it. I did say appraisal, but appraisal is a flat number where your area and region determines their appraisal cost, because their appraisers are going to set their own costs to every mortgage company. And it's going to be the same at every mortgage company. So have the conversation as far as what you see in Section A, as far as what you can and can't control as far as that lender to help offset some costs.
Ooh, perfect. Ooh, I love it. These are some good. So we got a few more questions for you before you have to leave us today. What should someone avoid doing before, after, or during the process of applying for a mortgage?
Do not co-sign for anything on anyone else's credit. I don't care what situation they are in. If you're in the middle of a process of buying a house and your mother, father, son, daughter, anyone has a situation where, hey, my card has went out and I need you to co-sign, don't co-sign until you buy the house. After that, you can, but if you're in the middle of the process of buying a house, that can completely deny your loan now, because we have to equate for that now in your credit history, and we have to now add that to your debt to income. There are scenarios, situations where we don't have to count it, but it has to take a year before we don't have to count it. But if you just did it, we have to count it, and now it could be a situation where you might still be approved, but it might not be for the number you wanted. So avoid at any cost co-signing for anything for anyone if you can. And if you have, just make sure that person is trustworthy enough for two things. One, to pay the bill on time, and two, that when the time comes, they give you the documentation to show they are the ones paying it and it has nothing to do with you. And we can omit that payment if they've been paying it for a year on their own.
Ooh, so good. Ooh, I'm writing down notes too. But please, y'all, don't co-sign ever. That's always my advice. Please don't co-sign. Don't take out nothing in your name. Just don't do it. Just don't do
Mm-mm.
it. So when they're going through getting a mortgage loan, how does locking your interest rate in work?
So it depends on the process, depends on your closing date, and depends on when you go under contract. If you're going to
Okay.
contract today, but you're not closing for 60 days, it's probably in the best interest to wait it out until you're within a 30-day range of
Mhm.
locking your loan. When you lock the rate, you're saying that you're locking the rate for the amount of days until your closing date. If you close before the lock expires, that's your rate. But let's just say you lock the rate on the first, you're supposed to close on the 15th, and for whatever reason the lock expires on the 14th, then you should hurry up and lock a new rate, because if it doesn't close and the rate expires, you are now subject to higher costs and
Mhm.
potentially whatever the new rates are for that market in the time that you're trying to lock the rate. So always talk to your loan officer about expectations of when they're going to lock it. What are they monitoring? Because just because your closing date is so far out doesn't mean you shouldn't lock it for a longer extent. But if you can hold off, you can technically see if there's a better cost when the time comes. But if they're watching the market and the rates do explode, it's best to lock your rate in for 45 and 60 days before it gets a trouble to you. So there is the possibility to lock your rates longer than 15, 30, and 45 days, but it's in the best interest to wait until you're within 30 days to lock your rate. And again, once that rate is locked, that's your rate up until the closing date. Once you close and we close before the lock expires, that's your rate for as long as the mortgage that you signed up for.
Okay. Ooh, ooh, these are so good. Listen, I'm trying to get my pen and paper ready. This is so good. So what is so for refinancing, when should someone refinance? I know that's a big thing. We always heard date the rate, marry the house type of deal. But when should someone refinance their home?
It's three things I would say. One, if there's enough equity in your house now where you're like, well, I want to see about paying off a car, because now you want to increase cash flow in the house. Maybe the rate is higher than what it was when you bought the house. However, if you look at, hey, if I increase my mortgage by $200, but I can get rid of a $700 car note by refinancing that and paying it off with the equity, then you just save yourself $500 doing that. So it just depends on your situation of, are you trying to increase your cash flow? Are you potentially having to buy a car and it's just easier for you to increase your mortgage by $200 to buy a $30,000 car versus taking out a $30,000 car note that's going to give you $600 to $800 a month? Like, it's about cash flow in those situations of
Mhm.
doing the refinance then, or yes, rates are better and I want to take advantage of that, so I want to refinance to get a lower payment on my house right now. The third option I would say is, it's tricky, but if you are in your situation, you say you have a second home, you bought a first
Yeah.
home, most people are going to buy a home, their second home, in the general area they're in right now. Not
Mhm.
everyone is moving to buy a new home outside of their state or outside of their country or outside of the city they're in. But Some people refinance their current house, like it's FHA. They'll refinance it into a conventional investment property loan so that they can still use FHA again in the same radius that they're in right now. Government loans do not like you to have two of the same within a 100-mile radius of each other. So the only way to get around that is to refinance yourself out of that program to put yourself in a different program so that you can then buy again using the FHA program per se.
Yeah, is there any time period? So like I got a FHA loan in 2023, and then I am buying a third home, but it's going to be my primary residence again.
Mhm.
So is there any time period between getting the FHA loan? Do I have to wait a certain time or?
So FHA is a flat rule of you can't have two FHAs within a 100-mile radius
Okay.
unless for three reasons they will let you get away with it. Number one, you're moving, so your employer is requiring you to move, but it's not quite a 100-mile radius away. Maybe it's 70 or 60 or 80, but it's an immediate situation. It's not in the best interest to refinance. So I want to use the FHA again. We do have to write letters. We have to prepare this and get FHA's approval. That sounds like a lot, but it's really kind of quick how they say yes or no to that. But they're going to want documented reason why. So if it's employment reasons, then we need a letter from your employer showing that they are requesting you to take this job, not you apply for a job and got a new job. It's, hey, the employer is shifting you out here to this way, and an immediate vacating of this property, I still want to use FHA to buy my next house. Or medical reasons is number one. Number two, where if you have a 2-story home, but now you have a medical situation where you can't go up and down stairs, but you have to vacate the property, go get a 1-story home. For that reason, FHA will let you do it within a 100-mile radius. The third one is extenuating circumstances of just natural disasters, and I have to move.
Okay, those are good. Those are good. So what is some tips that you have for first time home buyers to leave off
Number
with?
one, myfico.com.
Okay.
I'm not getting paid by them. I don't get anything from it, but it is the best service, period, as far as knowing what your credit is. When you see what your credit score is for a mortgage up there, the mortgage company's going to see the same exact score. The amount of conversations I have where I see people saying, well, Credit Karma is telling me my score is this. This is the only reason I even applied. I go, well, Credit Karma in the fine print tells you it's an Advantage score, not a FICO score. And they're telling you it's on a simulation of this is a best guess of the last 2 years information they have. Here's what your score should be. Whereas your FICO score is 11 years and this is what your score is. So myfico.com is probably going to be the best service you can use to know what your credit is before you apply. And then number two, have your affairs in order. Do not be afraid to hear you're not approved. If you're working with a lender who wants to help you, even if they can't get you approved today, they should still be able to tell you if you do X, Y, and Z in the next 60 days or the next 90 days, you will be in a situation where your credit's going to go here and we can get you approved. And they should check on you to make sure everything's going well based off the information they're giving you to get you approved. Because we're in a relationship business. No matter what they tell you, this is not a real estate industry. This is not the mortgage industry. It's the relationship industry. And we want to make sure we take care of the relationships we have, because without them, we don't get paychecks.
Exactly.
Now, with it, it still comes upon get your financial orders in place to know where you stand, where it can be better. And even if you can't get approved today, well, what can you do to better your interest rate? If you can increase your credit score in the process, why not do that too?
Okay. And one last thing is after we've closed on a mortgage and everything is all said and done, so I came to you, got me a new house, whatever. What is some advice you give for managing the mortgage after closing? Because I know my loan was immediately sold the first time after I closed.
If you're not working with a major retail national bank, your loan's going to be sold like 99.9% of the time. We're going to sell the loans. We're not mortgage servicers, like large mortgage banks are. Now, with it, you're going to get stuff in the mail saying, hey, your loan's been sold. This is who you should make your payment. Still do your due diligence to call the loan officer that you work with to make sure that's who it really was sold to. Scammers are very, very, very crafty. Scammers are going to do a lot of due diligence to get money out you. And with it, the Freedom and Information Act allows people to look up court records to see who closed on the house. If I can see your name on the records to show you just closed, today's the 10th. If you close on the house on the 7th, I can start sending you mail saying, hey, we didn't receive payment for X. Can you please send your payment here? It's going to have the logo for the company you work for.
Wow.
It might have some of the names involved. Maybe not all of them would be right, but it still have names involved that you're like, it looks familiar, so I'm going to send my check. That is a $1 billion industry of scamming that people do for like 2 years after you close in the house. They do that continuously to get you to let your guard down, to get you to get scammed. The worst I've ever seen was someone making 6 payments to a company, and it was scammers that took the money. Because again, the logo is going to look similar. They might have the exact logo. They might have the logo of someone involved. They might not even have who it is. So always call the loan officer or the company you are dealing with first to make sure that this is the company that you're supposed to be paying and that this is a reputable place that the money is being sent to. Because scammers do these things where they send you letters in the mail, emails, and even phone calls telling you, hey, we haven't received payment from you.
Wow, that is so good because I didn't know that even existed when you bought a house. You can look that up. I was wondering when I moved in here, I kept getting like salespeople. He would write like, "Yeah, you just bought this house. I'm trying to get you to buy a security system." I'm like, "How did you even know that I just bought a house?" Like he literally came to my house on 3 different occasions, and I was running from him because he was sitting in my house outside my house waiting on me. Like,
That's different. They don't usually do that. They usually just
yeah,
like do marketing. So again, I'm not
no,
gonna say it's just scammers. It is like she's saying, like home inspectors, not home inspectors, but security companies, roofers. A lot of different people are
yeah.
gonna look it up to see. Well, I'm gonna start sending you mailers to see if I can get you to buy my service because you're a new homeowner. Um, I never just heard anyone say they're gonna be standing in front of people's houses.
Yes, he was. He
Different.
came. I was leaving to take my kids out to their activities, and I seen him, but I was rushing. So I was like, he must be, of course, trying to sell me something. But whatever. I came back the next day. He was here again. I said, "Well, I seen you here yesterday. What do you want?" Like,
I did not know they do
he
that.
was like, "Yeah, I'm from ADT. I know you just bought this house." And I'm thinking, like, how did you know that I just bought this house? Like, how did you
Yeah.
know? So, oh my God, that is so good to know. No wonder I was wondering how he got my address. That is crazy that your address is that accessible to people.
It, certain cities kind of some cities will scramble at least your first and last name, but it still tells someone that the deed of record on this house has transferred to a new owner. So they at least know this address is under new ownership for someone new. Maybe they need service. Scammers just use that same reason. Say, hey, let's see how. I forget where you can look it up, but you can even see which mortgage company has closed on this house with you. So that's how they know who to use. Some of it is incorrect. Some of those names will get scrambled. For example, you're using a broker. It said you said United um, Mortgage lenders who you use. So
I use
you'll have
yeah, I'm about to say I used it was some local thing, but they sold it to Huntington. They used
Huntington.
Huntington. Yeah.
So it might not have Huntington. It might have that person you work with logo, or it could have Huntington's logo, but it'll have his name on it. So it's one of the things where you got to be mindful of. Let me call them to see if it's them. But at the same time, it tells you enough information to know this person closed on a new home and who the companies were that were involved. It might not give you direct names, but it still gives you something to use. And I just didn't know roofers and ADP sales rep. I didn't know all of them were using it, but yeah, that can
Yeah.
happen.
That was my first. I was like, oh, so I'm learning something new every time I buy a place. I'm like, this is new. I didn't have this happen the first time. But that's great.
Celebrities, they do things like, hey, they open up like dummy companies to close houses and dummy companies because that's
Wow.
how people find out. Like, what is it? The Hollywood Star, the Hollywood Home Tour. That's how they know who home it is because we can look it up and we'll just take you on tours.
So that's how they knock on people's doors and say, "Oh, such and such live here," and they just walk mosey on up to people's house. Wow, I did not know that. So I
You
guess none
gotta
of your
put that
information is safe.
you
That's-
gotta put that no soliciting sign so you can make it a legal reason that, hey man, if I see you on my yard again, it's gonna be an issue for
Mm.
you.
That's a good point. I need to get one of them then, because they do. I've had plenty, no lie, since I moved in here. It's been at least 6 or 7 salespeople that have came to my door trying to sell me stuff, and I'm like,
Yeah.
Where are you getting my information from?" So that was a good note for me. So I need to get me a no solicitation sign.
It was that aggressive. That's
Yeah,
different.
they're very aggressive. I don't know if it's some new thing, like you said, to get scammers or buy
Mhm.
something, but that stuff is scary.
That's different.
Yes. Okay. Well, thank you so much. So, where can we connect with you? I know you say you're in Virginia. Any of our Virginia listeners, please speak to Brian. I will link his information in the show notes so you guys can reach him. Do you only originate loans in Virginia or?
Oh, right now I'm only in Virginia. I do plan
Okay.
to go basically the whole Mid Atlantic and do Maryland, DC, North
Okay.
Carolina, and potentially South Carolina. But right now I just want to reconcentrate on just North Virginia right now.
Okay, perfect, perfect. So our Virginia listeners, I'll make sure I'll link you in the notes so you guys can reach out to Brian for any lending, any questions. And what last thing would you like to leave our listeners off with today?
To avoid anyone who is an investor, if you are an investor, there are products that allow you to buy, even if you're not an investor, you want to become an investor. There are products in which it allows you to buy investment properties without having to provide pay stubs and W-2s. It will take just the property that you're buying and see what the rent will be based on the area, and say if the rent covers the mortgage, then you can buy it without having to provide pay stubs or W-2s. You just got to have the credit score and the down payment to take care of the house in itself.
Oh, well, thank you, because I need that note too. Too bad I'm in Ohio. I need to find me one.
No, you say you talk to somebody up there, just ask them, hey, I heard about something that's called a DSCR loan. I want to know if I can take advantage of it. And I'm going to be honest, it's a national program. It's not central to just me. As much as I want everybody to use me,
Yeah.
DSCR loan is something that will let you buy without having to have pay stubs or W-2s.
Yeah, okay. I did look into that for my first property, so I can pull the equity out, but I just didn't want to refinance my I didn't want to redo my loan because I got one of those COVID rates for that first property.
Mm-hmm.
So I wanted to leave my COVID interest rate intact.
So the DSCR loan is never going to touch any of the equity in your home at all. It's just going to be the house you're buying.
So it's just for this. So, okay. So I was just trying to pull the money out one that I already had with DSCR. So you can do it on another, brand new one.
Maybe, so it's called the HELOC loan, where you pull equity out of your house to use it as a loan to then use it forever you want to. But the DSCR loan is called debt servicing coverage ratio loan, where you could potentially look at an investment property, and if they say, hey, you and your real estate agent did the due diligence, and the rent will be $2,000, but the mortgage is $1,999. As long as it's $1 more, you can buy it using this program. And all they'll let you do is you have the credit score to take care of it, and you have the down payment and closing cost to buy. They don't ask for any pay stubs, W-2s, no income docs from you whatsoever.
See, she didn't tell me that she was just going to pull the money out of my first one. See, she didn't tell me I can do it for a whole new. She was just trying to tap into my equity because, it's harder to get HELOCs on investment properties. So I have been having a hard time finding a lender who would give me a HELOC because of, I had tenants in there. So she was just pulling out money, but she was going to redo my whole loan because I already had one. So I was just like, no, I'm not trying to redo my loan. But she didn't tell me what you just told me, which is some really, really good information. That's really, really good. Okay, I need to. Yes, that's good. I need to use that for myself. Well, thank you, Brian. That was so good. We appreciate all of your good information. This was a really, really good episode. Like I said, everybody, please connect with Brian. His information and social media will all be linked in the notes. And thank you for listening to the Get Your Coins Sis podcast. This is your host, Nell Latrice, and I'm out. Bye, y'all. Thank you for tuning in to another episode of Get Your Coins Sis podcast. We hope you found today's discussion insightful and empowering. Remember, every step you take towards personal growth and financial literacy brings you closer to your goals. Stay connected with us on social media and share your thoughts and stories. Until next time, keep striving, keep believing, and keep trusting in God's plan for your life. Stay blessed and see you in the next episode.